Assalamualaikum warahmatullahi wabarakatuh to Madam Nadia. I will start the presentation with our content, which is different between conventional finance and Islamic finance. This presentation will include definition, value proposition and structure, operational mechanism, financial instrument offered, and conclusion. I will start the presentation with conventional finance. Conventional financing is a transaction based on interest rate for saving surplus or deficit spending units to loan or borrow funds in financial market. In conventional financing, lenders lend to borrowers to make a profit from the interest charged on the principal amount. It also a home financing scheme offered by financial institutions or banks, which are not guaranteed by government agencies. Next, Islamic finance. Islamic banking, also referred to as Islamic finance or Sharia compliant finance, refer to financial activities that adhere to Sharia. Two fundamental principles of Islamic banking are the sharing of profit and loss, and the prohibition of the collection and payment of interest by lenders and investors. Islamic banks make a profit through equity participation, which requires a borrower to give the bank a share in their profits rather than paying interest. Some conventional banks have windows or sections that provide designated Islamic banking service to their customers.
The value proposition of Islamic finance is different from conventional financial intermediations. There are a number of notable differences between the two industries. Sharia compliance is the defining characteristic of Islamic finance and therefore the basis of its value proposition. Islamic finance industry is not averse to profit making. The value proposition is more of bringing benefits to those types of their consumers in a mutually beneficial manner through partnership modes of financing. The other value propositions of Islamic finance are firmly rooted in the Maqasid al-Sharia, traditionally involve ethical investing and green business. At consumer level, one may ask whether the consumers of Islamic finance products are reasonably protected from financial market manipulation. The Sharia compliance of the structure related to a large extent to the value propositions of Islamic financial intermediations. The weakness of the regulation in some countries has unfortunately created an opportunity of some Islamic finance institutions to go haywire with special reference to the prudential management of clients' funds. The above recommendation is meant to enhance the value proposition of Islamic finance as a global industry. The value propositions of the conventional finance are geared towards customer-friendly customer service that are meant to attract more customers with the ingenious objective of profit maximization. Then, if the value proposition of conventional finance involves socio-economic benefits for the consumers, there would not be any needs for socially responsible investing. Now we move to the structure of Islamic finance and conventional finance. Islamic bank is supposed to be set up based on the theory of sources and implications of funds. There should be a single flow between the deposits and the financing investment. Use of funds means there is no listing function. It is a single function where customer deposits or investment pool is used to fund financial portfolio or deploy into investment instruments from which return derived and recognized. When the returns are determined, these returns are shared between the bank and the customers. This profit-loss sharing structure demands a different way of managing the bank, although not all Islamic banks are able to successfully pull this off 100%, especially when the Islamic banks are under the parentage of conventional bank. For conventional banking, the purpose of setup is to collect deposit and to give loans. This is the shareholders' understanding of what it should be. There are two very distinct functions of conventional bank. In example, collect deposit and give loan, and the arrangement is managed by treasury function, which try to balance the returns to shareholders' fund. The process in an Islamic bank and conventional bank are also different simply due to the structure of which it has been set up. There is a broader requirement for oversight and research required to ensure that Islamic products and service meet Sharia requirements. A lot more layers to comply with a lot more details needed.
And now, I will explain on the operational mechanism. An initiative's pace and direction can be managed via operational mechanisms. Although it is crucial of the components, this is the easiest. Reports and reviews are commonly used to describe operating mechanism. Now, we want to know what are the differences between operational mechanism in Islamic finance and conventional finance. For the Islamic finance, usuri and interest are prohibited in financial transactions. It is meant to ensure equity in exchange. Next, miser prevention is a must since miser creates wealth from chance instead of productive activity. Sharing of profit and loss in Islamic finance has a fixed rate for the fairness. In addition, finance solely for halal businesses. And the last one, the prevention of gharar, because gharar can arise where the claim of ownership is unclear or suspicious. Next, for the conventional finance, usuri of interest rate tolerances in the banking, since it does not follow the Sharia law. Every firm needs financing since money is considered as commodity in conventional finance. Next, getting finance from investing in industries that are prohibited, such as bar that sell liquor. And the last one is profit loss sharing of conventional finance has no fixed rate.
Assalamualaikum, my name is BASYIRAH. So now I will discuss about instrument offer. First, deposit or liabilities. For Islamic bank, it offer deposit product based on the following structure. First, got its current account are offered under this contract, where the risk of the fund and no added benefits are provided to the client solely based on this facility. While conventional bank accept deposit on the basis of loan for all types of deposit account, including terms deposit, saving and current account. Interest-based are written provided for the service account and term deposit, whereas the current account may offer free banking facilities. Second is lending or financing. For Islamic bank, it offer financing and lending facility to their client to fulfill their business requirement, while for conventional bank, it offer lending facility to their client to fulfill their cash requirement on the basis of law contract, where the relationship between the bank and client is lender and borrower respectively. And the last one is trade finance. For Islamic finance, it also offer traded finance related operational under the concept of service warranted and financing, while for the conventional bank, it offer traded financing related operation under the concept of service warranted and lending.
To sum up, with increasing maturity of Islamic finance, the differences between Islamic and conventional loan products have narrowed considerably. But Islamic finance is better than conventional finance because it follows the Sharia law and free from prohibited elements.